let you know that we will be recording this session. So if you wanted to turn off your camera, feel free, unless you wanted to be included in that recording, then leave it on. But yeah, welcome. My name is Sue Logan. I'm the manager of Melbourne's North Advanced Manufacturing Group here at Northlink. Yes, that's me. And you can find my details. If you scan that code there, you'll get my details there. So Northlink is a connector in Melbourne's north. We work with government, with education, with health providers to ensure. Oh, sorry, I'm just wondering if people could mute themselves because we're getting a lot of feedback. Great. Thank you so much for that. Yeah, as I said, Melbourne's Northlink have been around for 30 years. Our aim is to ensure that Melbourne's North prospers. So we're a connector of businesses, of education, of health, of government, local government, state and federal government. So please feel free to scan that code to get in touch with me later on. So I'll just run through the acknowledgement of country. So Northlink acknowledges the Wurundjeri Wurrung people as the traditional owners of the land on which we work. We pay our respects to their elders past, present and emerging, and we recognise their rich heritage and continuing connection to land, waters and culture. So thanks so much for joining us today. It is a really important topic. We're really pleased to have Sam Zebrowski from William Buck, a founding partner of Melbourne's North Advanced Manufacturing Group. So Sam's a principal business advisor at William Buck. She works with a diverse portfolio of clients, including small, medium businesses and large corporates. She's valued for her ability to translate complex issues into clear, actionable insights, and her focus on what matters most helps clients move forward with clarity and purpose. Known for her genuine and approachable style, she ensures clients feel supported and confident as they navigate both day-to-day decisions and long-term planning. She is energised by the innovation and resilience of the manufacturing sector and is committed to helping these businesses strengthen their operations, meet regulatory requirements and plan sustainability for the future. Sam's also one of the key members of Melbourne's North Advanced Manufacturing Group's Industry Advisory Committee, and I can actually vouch that with her style, she explains things, and I'm sure she's going to explain everything really clearly today. We've actually got a lot to get through, so we'll make a start, and I'll hand over to you, Sam.
Thanks, Sue, for the lovely introduction. It's lovely to be part of Melbourne's North Advanced Manufacturing Group, and really love working with manufacturers. I really appreciate everybody for joining on our webinar today. There is a lot to go through, as Sue mentioned, so we're going to get straight into it. So Same-Day Super is one of the most significant changes to superannuation compliance we've ever seen. And for many employers, it's going to mean a real shift in how payroll and cash flow are managed. Today, we're going to walk through what Same-Day Super actually is, how it differs from our current rules, and what it means in practice for all of your businesses. We'll also touch on the risks, particularly around late payments, and some practical opportunities and planning tips so that you can stay ahead of the changes. We are going to finish up with a Q&A, so there is a chat box there if you want to either put your questions in as we go or at the end as well is completely fine, and we'll get to those. So yeah. To kick us off, why are the super rules changing? So before we go into the detail, it's helpful to take a step back and understand why this change is being introduced. At its core, the reform is about closing the gap that's existed in the system. There are currently millions of dollars per year of unpaid super payments, and the gap between when super is earned and when it is actually paid can be quite significant. In some cases, that gap can be months, and in worst cases, super can go unpaid entirely without being picked up or paid. Over time, that has a real impact on employees' retirement outcomes. So, one of the main drivers here is to reduce the unpaid and late paid super. By requiring contribution to be made much closer to when wages are paid, there's less opportunity for obligations to fall behind, and it improves retirement outcomes more broadly for employees because contributions are received and invested earlier. From a client compliance perspective, this is really about moving super from a periodic obligation to something much closer to real time, aligned with how payroll is already reported through single touch payroll. And that means much greater visibility for the ATO, and issues like non payment and late payment can be identified much earlier. Importantly, it isn't just a timing change. We're also expecting more significant penalties where there is ongoing or repeated non-compliance. So the cost of getting it wrong becomes much higher. So while the intent is positive, there is a meaningful shift for employers from a flexible periodic obligation to something much closer to real time with far less room for error. Sorry, just trying to change my slide. Here we go. What is Payday Super? So Payday Super basically means that the super contributions need to be paid at the same time as salary and wages, effectively every pay cycle instead of quarterly. So rather than having up to 28 days after the end of a quarter to make payments, the obligation shifts to being tied directly to each payday. Importantly, this applies to all employees or contractors who are eligible for super guarantee. So for contractors, it becomes part of a standard payroll process rather than something that's managed separately. A key point is around the timing. So contributions are only considered paid for the purposes of Payday Super when they're actually received by the employee's super fund. It's not just about when you process the payment, but when it clears and is received. This is a very important point, and we'll touch on this again throughout the presentation. From a practical perspective, this aligns super much more closely with single touch payroll reporting. And as a result, it significantly increases the importance of payroll accuracy and process discipline. Errors that may have been picked up and corrected over a quarter now need to be identified and resolved much more quickly. This isn't just a change in timing, it changes in how super needs to be managed operationally within a business. We move to the timing rules around Payday Super. So, as I said, in general, super payments need to be received by the employee's fund, and this needs to be within 7 business days of paying wages or other eligible payments. It's not enough to just process the payment, it must actually reach the super fund within those 7 business days. Many payroll platforms will allow for real-time payments, which makes meeting the deadline much easier. That said, not all providers are ready. However, many are indicating that they will be by the deadline of 1 July. So it's important to check your systems now and to plan ahead to avoid any surprises. Also, unless your specific platform has functionality to notify you that the super fund has received the payment, there is no actual notification requirement or obligation to be notified that's built into the platform or the rules. If you do have a new employee joining your business, or if one of your existing employees changes their super fund, the first contribution has a longer window of 20 business days to make the first payment into the super fund, and then after that, it reverts back to the standard 7 days. For any out-of-cycle payments, maybe like bonuses or commissions that aren't paid on a regular basis, these need to be paid within 7 business days of the next regular payday. So very much still tied to the payroll cycle. So we've got a bit of a visual table here to try and bring it all together to see how the new Payday Super rules compare with the current system. And for this particular example, we're looking at somebody who's being paid on a monthly basis. So at the top of the table is looking at the current rules. So those yellow dots. So someone is paid on pay cycle 1, pay cycle 2, and pay cycle 3. That's essentially 3 months of salary on payments. And then the super payment is due at the end of the quarter where the orange dot is on the side. Under the new rules, we've got the blue dots. The super becomes the blue dots instead of the orange dots. So we still have our 3 pay cycles, the same with the yellow dots, but now our super is paid 3 times. So we've got our pay cycle 1, super payment, pay cycle 2, super payment, and so on. So that's kind of a visual of how that's going to change. The shift basically dramatically shortens the period between when the super is earned and when the payment is made. This is set to improve outcomes for employees in that their money is invested sooner, but it does increase the operational demand on your payroll and finance teams. Over the next section of the presentation, we're going to look at what's actually changing. So we've talked a little bit about the payment timing changing, and we will look at that a little bit more as well. But there are other changes that are coming through with the same-day super rules, and these aren't being talked about enough, in my opinion. So we're going to cover those now. So we're going to focus on the key practical changes, including what counts as qualifying earnings, the timing obligations, the new penalty rules, and the reporting requirements. So qualifying earnings. This is a new concept under the rules. We haven't had qualifying earnings as a concept before. Employers will now use qualifying earnings, or QE, as the basis for calculating super guaranteed contributions and the super guaranteed charge. Most employers will see no change to the amount of superannuation between what you're paying in the current rules and the new rules. However, there are some changes. Qualifying earnings is made up of many different components. So that is ordinary times earnings, including payments for ordinary hours of work, including certain types of paid leave, allowances, bonus, and lump sum payments. And there are no changes to what payments are considered ordinary times earnings under Payday Super. Earnings paid to workers who fall under the expanded definition of employees for superannuation payments will also fall into these rules with qualified earnings. There are some payments that may fall into more than one category of qualified earnings. However, these will only need to be included once in your calculation. So it does remove any double ups or duplications. So you're not paying double the contribution. Importantly, the existing super rules include an expanded definition of employee for the purposes of super guarantee. And importantly, this is not changing under Payday Super. These rules can mean that super is required for individuals who aren't traditionally thought of as employees, and it can include directors, certain contractors, and those paid to perform or participate in artistic and sporting activities. Not that artistic and sporting activities are usually relevant for manufacturing businesses, but they do get caught up in these rules. So if the definition isn't changing, why are we talking about this as part of the same Payday Super environment? What we're seeing in practice is that not all businesses are currently paying super for their extended definition of employees. And for those who are, the payments are not necessarily being processed through the super clearing. But that is going to have to change as part of this process, and the timing rules are also going to change. So currently, if you do have contractors who are deemed to need to have super payments, you may need to review your current payment processes, where if this is currently being processed by your accounts payable, that may need to change to come into your payroll processes. That does depend on the individual processes within each business, though. And that does make the process more challenging and more that you need to have set up and ready to go. As a result, we recommend that businesses review their internal processes and responsibilities to ensure that everything is captured correctly and reported on time. And if you're unsure about how the expanded employee rules work or may apply to your business, it's worth seeking advice from either your accountants or lawyers to ensure that you have the correct treatment, as this area is worth getting right up front, as it can be quite important. From here, we're going to look at systems and data matching. So as part of these changes, there's going to be new STP reporting codes and requirements as part of your payroll process. We're still waiting on all the software providers to actually have all this information ready in the software to be able to set it up, but it is coming. Under the new rules, both qualified earnings and super liability information will be captured under single touch payroll. This will therefore require all businesses to review their STP setup once the software providers are ready. This additional information will be giving the ATO far greater visibility over super liabilities and the timing of payments. In effect, it significantly reduces the gap between when something is reported to the ATO and when it's actually paid. From a compliance perspective, it means that late or missed payments are much easier for the ATO to identify, and they'll be able to do it much earlier than they're doing now. A quick tip: make sure your ABN is reported correctly in your STP setup, as this is part of how the ATO are going to do their data matching, and it can be as simple as having your ABN with a typo incorrect that historically hasn't mattered. That might be enough for them to trigger you have unpaid your super when you might have, and then it's just an additional administration burden on the business. So before we look at the next thing that we're going to look at, is the late payments and penalties under Payday Super. Before we do that, though, I thought it was really important to cover what the penalties are now so that you can better understand the changes. Now, this is one of the biggest changes under Payday Super, other than the timing of the payments themselves. So we do look at this for a few slides. Under the current rules, if super is not paid on time, it can trigger an SGC statement. There are three components of SGC, so that's the super guarantee charge. The first is the unpaid super guarantee amount itself. The second is a notional interest component. The rate is set by the ATO, and this is designed to compensate the employee for delay in receiving their super late. And the third is an administrative penalty or fee. At the moment, this is set at $20 per employee per quarter where there's a shortfall. At the moment, this process is self-assessed in that you are supposed to tell the ATO when you've made a late payment and then complete an SGC statement. The ATO will come to you eventually if you haven't done that, but the timing of when they're doing that is quite significant. And interest continues to calculate up until the SG statement is lodged, even if you've already made a payment. So what is changing? Under the new laws starting from 1 July, the SGC calculation is expanding and now has 4 components. So the first is the total amount of unpaid super guarantee. However, this is now based on qualified earnings. The second is the interest component, which again is applied to super on qualified earnings. The rate is also still set by the ATO for that. The third component is the administrative uplift And this is one of the most significant changes, as I mentioned. Instead of a fixed $20 per employee, this penalty can now be up to 60% of the super shortfall. So we're moving from a relatively minor fee to something significantly more substantial. And we'll look at this in more detail on the next slide. The final component of the SGC is called choice loading. This is a 25% penalty applied where the choice of fund rules are not followed. So what this means is if you have an employee who has nominated a super fund and given you their details for their super fund, and you make that payment into a different fund, for example, sometimes you might have set them up with a default fund instead of using their fund, that you will then have to pay this choice loading. We don't expect to see that very much, but it does happen from time to time. So overall, while the structure is similar, the key takeaway here is that the cost of getting it wrong or paying late increases significantly under these new rules, and it's quite substantial. So focusing on the penalty, the administrative penalty portion now, as I mentioned, this can now be up to 60% of the super shortfall and national earnings. So the 60% is kind of where the penalty starts, and then you have to meet the triggers to have it reduced. So, for example, two ways that this can be reduced is if, as an employer, you have not had an ATO initiated assessment in the past 24 months, they will reduce your penalty from 60% down to 40%. Or if you have made a voluntary disclosure to the ATO before they commence an initial assessment, they will also further reduce this by 20%. Or if you have both, you can get both reductions. It's important to note here that the ATO is still working through the process of how that voluntary disclosure is going to work. So there's a bit we don't know here in how you would actually practically do that. So we're still waiting for some clarity for the ATO onto how that will work. The main reason is under the existing rules, the SGC statement is self-assessed, whereas under the new rules, we're kind of expecting that the ATO is going to come to you. So it's quite hard to stop them if they're coming to you. So we're just waiting to see what that will look like. It is important to note also that while it's not in the legislation, the ATO have said that they are going to try and not be harsh with penalties in the first year for businesses who are trying to do the right thing. And there is some guidance on what they consider doing the right thing. And they will consider factors such as compliance history, whether the issue is one-off, ongoing, and the level of cooperation in resolving the problem. So there is a few things that they'll consider for this in the transition period, but going forward, they will be applying this quite harshly, and this is a significant change from where we are now. In addition to these penalties, there are some other changes. So from 1 July, under the new rules, the SGC payments will become tax deductible. So they're not currently, but they will be. It's important to note that this deductibility, though, is limited, and it does not extend to any general interest that accrues once the SGC statement is known, or if there's any penalties applied for failing to pay the late super once you've been issued with the SGC statement. So while there is some relief in terms of the underlying amounts becoming deductible, the additional costs associated with non-compliance still remain non-deductible, and the penalty amounts are much higher. It's also important to note the timing of payments. So if an SGC amount is not paid within 28 days of a notice being issued by the ATO, they will apply further penalties. This is going to be known as a late payment penalty, which is also quite significant. and it is generally going to be 25% of the SGC amount for the first breach and increases to 50% if there are subsequent breaches within 24 months. And these penalties cannot be remitted for any circumstances. That's what they're saying at the moment. So whilst the introduction of deductibility is a positive change, it doesn't remove the financial consequences of late payments or getting it wrong, particularly where there is repeated or problems that are not addressed. So it's really important from a cash flow perspective to get this right. So we've talked a lot now about what's changing and what's happening. Before we move on to some other changes, I thought we'd go through a really simple example. So basically in the scenario we've got here, we've got a medical center. Now, whether it's a medical center or a manufacturing business, the example still is the same. So we pay wages to our employee, Sarah, on the 3rd of July. Based on the new rules, the associated super contribution should be received in her super fund within 7 business days. Now, the 3rd of July is a Friday, so we've got Saturday, Sunday as a weekend. They're not business days. And so as a result, the payment needs to be received by her super fund by the 14th of July. However, the business doesn't make the contribution till the 20th of July. So we've paid it 6 days late. That doesn't seem like that much. However, under the new rules, even though the payment was paid, it was still paid late. So the full $500 is treated as part of the calculation for the shortfall of the SGC purposes. And interest and penalties are applied. Using the current rate set by the ATO when they assess this and update it quarterly, interest would apply from the 14th of July to the 20th of July. And based on the current GIC rate, it would result in $1 of interest. Now, that's really small and insignificant and seems really minor. But there's also the administrative penalty that would apply, which will be, depending on your compliance history, up to 60% of the $500 of super contribution that should have been paid. There's also the administrative time and effort in tracking, reconciling, and reporting these shortfalls, especially when you multiply this of the number of employees and instances where this might happen. So whilst the dollar of interest might not seem significant on its own, there's all the other components of the process that can add up really quickly, particularly, as I said, once penalties are layered on top of this example. The key takeaway is that even short delays can trigger SGC consequences, and the operational effect to correct them is definitely significant. Some other key considerations and opportunities that we can consider. So let's look at cash flow considerations under Payday Super. So as we've talked about, one of the main impacts to businesses is there's less ability to hold on to payments until the end of the quarter, as super payments now need to be made much closer to payday and in line with each pay period, meaning earlier outflows of cash and increased requirement to plan for your working capital. This will be particularly noticeable for the April to June 2026 quarter because the new rules start on 1 July. Payments for this period will likely also fall in July. This will likely create additional cash flow pressure as businesses adjust to the new timing. There are opportunities to manage this proactively depending on your business, and some of these might be reviewing your payment terms with your current customers and see if you can help to align this with your pay periods to help ease the pressure of the super obligations. However, that may not always be possible. Another consideration that we're hearing about is employers considering changes to their pay cycles. So, for example, we've heard businesses talking about changing from fortnightly to monthly pays or weekly to monthly, something like that, so that the frequency of the payments is less often, and therefore the administrative time attached is also less often. And that may be an option. However, please, before you do that, keep in mind a couple of important considerations. There may be terms under your existing employment contracts that may limit what changes are possible. Secondly, there are potentially employee awards or enterprise agreements that could impose restrictions on the frequency in which you must pay your employees. The Fair Work Act also sets minimum requirements that must be paid at employees must be paid at least monthly. And finally, it's essential to provide employees with sufficient notice that if you are going to make any changes, so they can plan ahead for that. So while reviewing pay cycles can create efficiencies, it's not simply a matter of choice. There are legal and contractual obligations that must be followed. This is a good opportunity to check your employment contracts and support any changes that are possible if you want to, and have those early discussions. Depending on the complexity, legal advice may be required to ensure compliance with contracts, awards, and legislation. Planning ahead is essential because proper planning can ensure that your business can meet the super requirement early without creating any unnecessary strain on your payroll team or your employees as well. A quick note for your new employees. As you mentioned at the start, the 7 business days for new employees is increased to 20 business days for their first pay run, which gives you extra time to set them up and ensure contributions are accurate. Another new feature that's coming in with the Payday Super changes is some super stream functionality. So this will allow businesses to complete a new member verification request. This can be for either new employees or employees changing their super funds as well. It'll allow you to confirm the super details provided by an employee on their choice form without actually having to run a pay run, because it will tell you that yes, the contribution would be accepted or wouldn't be accepted by those super funds. It's particularly useful given it gives you the ability to go back to the employee if there are discrepancies or issues before the contribution is being made, and reduces the time between when the payment is made and how long you have to correct and avoid any shortfalls. Another change as a result of the Payday Super is the calculation to the maximum contribution base. So there's currently a formula in place for this. However, it is changing from 1 July. And based on the current requirements of 12% superannuation and 30% contribution caps, a maximum contribution base of $250,000 applies. So when an employee's qualified earnings exceeds the maximum contribution base in a financial year, an employer is not required to make additional SG payments on the excess. That in itself is not new. It's just the formula to do the calculation that is. However, just be careful that you're reviewing your employment contracts to make sure that they're worded in line with this. And you need to make sure that you are reviewing the cap proactively throughout the year so that you're not exceeding it. There is an important first-year consideration that timing changes of contributions may cause an employee to go over their concessional cap that they would not normally have done. So now that there may be a period with a 13th payment, for example, if someone is paying monthly, this could cause them to go over their concessional caps, and then the employee will be charged excess contribution taxes when they go to complete their tax return. Treasury are currently considering some possible relief that may apply in this situation. However, it's not yet formalised and we haven't seen any drafts on what this could look like. So again, watch this space. Before we wrap up, there's 2 more things to look at. So some potential pitfalls. If you're currently using the ATO Small Business Super Clearinghouse, this is being decommissioned. So from the 1st of July, you will no longer have access to this. You will lose access in entirety. You will not even be able to see any historical data. So you need to go in before the 1st of July, pull out any reports, data, information, history, and get this set up into a new clearinghouse so that you're ready to go once the kickoff starts. Businesses in this situation will face additional work to find an alternative platform for super payments and to be ready on time. So we recommend starting this as soon as possible. And there are several options available, including accounting platforms like Xero or MyOb, or some industry super funds that are offering their own super clearinghouse platforms as well. Uh, some other potential pitfalls includes the timing. The 7 business day rule can be timing with terminations and irregular pays, and as well as assuming that because you're using compliance software, it automatically makes you compliant. So what we're expecting to see is that rejected contributions could be an issue. If you don't notice the rejected contributions back into your bank account, you may not find them in time to correct the payment before the end of the 7 business day requirements. And so internal processes and monitoring is going to be really important as a control to ensure that there's no unexpected penalties and also for ongoing compliance. So not just once you've set it up in July, but to make sure that it's ongoing compliance as things continue. And so to put this all together and wrap up, we strongly recommend that businesses start early. Map out your current processes to identify any changes that need to be made, including ensuring that your software will be able to facilitate these changes. Review your employment contracts and contractor obligations, and communicate any important changes with your employees. Plan for cash flow changes, and then making sure you're monitoring cash contributions actively. These changes are manageable if you plan ahead, review your processes, and ensure your team is ready. Businesses who are taking proactive steps now will avoid any, or hopefully avoid any last minute issues, reduce the risk of penalties, and ensure a smooth transition to the new rules from 1 July. So thank you for joining today. I know we went through a lot in a really quick period of time, so I do want to acknowledge and appreciate that. But we do have some time for questions as well. So if you do have any questions, please put those into the chat box and we'll cover as much as we can before the time runs out.
Thank you so much, Sam. That was really insightful, and I'm sure everybody online found that insightful as well. I think there's a lot of information, but we certainly don't want the ATO to be coming and looking at anything that we do. So let's try and adhere to everything. I did see that Lisa had a question in the chat there, Sam.
All right, hang on. I can't see the chat. Give me a second.
It says, where do you go to run a member verification check?
Thank you. We're expecting that to actually be through your STP platform, so kind of where you're running your wages and super out of. I haven't seen any providers actually having this ready to go yet. So it's a watch this space item, unfortunately.
Thank you. And thanks for the question, Lisa. Any other questions there? Feel free to ask or put them in the chat. We've got a couple of minutes left. One of the things, sorry, Sam, I was just going to say, go on.
So I was just going to add, there is a current stapled super fund check that you can do through the ATO. So if you get your employees' date of birth, tax file number, and all their personal information, you can put that in there and it will tell you if they have an existing super fund and provide you with that information. That's an existing service that's available, but it's not built into the super platform for now. So they are kind of building that in.
Thank you. Any other questions? I was going to suggest people make sure that they've noted Sam's email address if you've got any further questions after today, and also to subscribe to William Buck's newsletter and Northlink newsletter. You'll often find lots of really helpful information in there. And I'm sure that Sam and William Buck will be putting in any further updates. Thank you, Lisa. Appreciate that message. Okay, any further questions? Sam, anything else before we head off?
No, I just echo what you said. So thanks everyone for joining. And yeah, please, if you do have questions once you start working through it, don't hesitate to reach out.
Yeah, great. Thank you. And again, thank you, Sam. Thank you, William Buck. Thanks everyone for joining us today. We hope that you found the webinar really helpful, and have a fabulous weekend, and may your football team win. Take care, everyone. Thank you.